everyone. Welcome to another episode of Cryptocurrent. Your host here, Richard Carthon. And today I got a special guest who I had the pleasure of meeting in person at a plethora of different places, but is working on an extremely cool project that I think everyone needs to be paying attention to because I think is pretty revolutionary, and when pulled off will be something that everyone needs to be paying attention to. We have Jonathan Libby with Steady State. How are you doing today?
Doing good, man.
Man, I appreciate you joining us today. I want to unpack a lot with you, but before we do that, I want our audience to learn a little bit more about you. Give us some background on yourself.
So my background revolves around finance. You know, before I got into crypto, I was really deeply in finance and big nerd. You know, consulting, strategy, IB, insurance, all that stuff. I've studied and learned. And then my first kind of exposure to crypto kind of came in the fall of 2019. Leighton Cusack, he's the founder of a project called Pool Together. Was one of my first projects I was exposed to. Pool Together is a no-loss lottery savings account for people. It's kind of how it functions. It's very, very powerful. But what interested me about what he was doing was not necessarily Pool Together. It was compound finance. It was generating the APY returns. And I was trying to ration how as a finance nerd, I was trying to ration how someone could generate lending APY by the second. And I'm like, what? And I was like, that's impossible. That's a scam. And the more I researched it, I'm like, holy crap, this is a scam. And ever since then, I've been falling down the rabbit hole of DeFi and crypto and really just diving in. I started buying crypto in that 2019 as well. My first big purchase came in the COVID-19 crash. Very blessed for that. And then, and I think my whole, really everything, everything I believe about DeFi kind of was realized fully, I think, when Year in Finance came out, where how it works is a smart contract, where I deposit my USDC into a smart contract and get the highest APY lending between synthetics, Aave, and compound with your money naturally moving. And all I could think about is if you could do that to a bank, what would that do to APY? For all banks that are now aggregated where your money's going to move the highest APY at all times between banks. It's it's going to force these guys to start strategy. How do we start making these people more money? And it was just really powerful. And I think, that's kind of my background, my intro to crypto.
Man, that's great. And a lot of people, and the reason I always like to ask about backgrounds is you came in fall of 2019. So you've been in the game for about 2 years. Some people that we bring on the show have been in the game for over a decade. The point being, everyone listening, whether you're a crypto OG or you're new to the game, whenever you get involved, if you see where the opportunity is, you can get started and you can have something pretty massive that is helping to move the needle in the world of crypto. And one of the things that was brought up multiple times was APY, so annual percentage yield. And what's great about that for most people who don't know, if you have a savings account in traditional banking, you might get 0.01% on your money. Whereas in crypto right now, you can see something as low as 3% all the way up to 20% or even higher, depending on where you're at. And so it sounds like in a lot of ways, this is what the introduction for Jonathan was. And he said, wow, this is really cool. How can I make this more accessible to more people? And how is this not a scam? So is that kind of the premise of how Steady State came to be?
Steady State actually came to be more, I thought, not necessarily how is it not a scam, but it was more I want everyone. I believe crypto and decentralized finance is going to transform money and how we understand money, not just it's just everything's going to be stable coins, but I think the average returns for people in many ways it's going to be, things are going to really alter and change. But the many way returns, I think people are going to see on their saving, on their investments, rather than being 7 to 10% annually if they're lucky, it's going to be 20 to 30, and at least, I think, and that's going to totally reinvent how we understand finances and growth. And my view on returns are totally warped now. It's because of the space. And my kind of steady state came to be with a fundamental belief where I want everyone to be exposed to the space for mass adoption, because I think it'd be one of the greatest ways to create wealth equity among large groups of people would be in crypto and DeFi that cannot be achieved in traditional finance how it works now. Poverty and equity is a very important issue. I think if you solve people's money problems, you can solve a lot. They can solve the rest. And so that's kind of what why I say Steady State was kind of the belief for I want crypto to be here for everyone. And one of the key problems is no one understands it. And if people want to use it, if people are offering to use it for them, they want to know, are my assets protected?
Right. And what I think is great about as people start to learn more about APY is you always think about like, how do you create multiple streams of income? And one can be just having your money sit and make money for you without have it being in a secure and safe place, and having it be liquid if you need it to be. But again, it's still making money for you. The challenge with savings accounts where people go and build that is that, yes, you have this liquid money, but it's not making you money. It's not really doing anything other than having this liquidity available in the event that something bad happens. But why not be able to still have that security, but then also have it make money for you as well? And so I kind of want to now break down, what is steady state, and what are you ultimately building with it right now?
So steady state is kind of two things, but let's start with kind of what it is at the base. We're trying to create insurance for protocols. So currently in the space of DeFi and crypto, if you can use all these protocols, there are a lot of risks when you use these protocols, all mostly technological. If I put $100 in Curve, I am scared when I wake up tomorrow that money in Curve's gonna be gone because someone hacked the money and just stole the pool. That's one of the biggest fears we all have using the space, and it's a very rational fear. And currently, the avenue of protection in the space is through retail insurance, where I have to get insurance to my exposure to every protocol I use in the whole industry, DeFi, mostly in the Ethereum chain. I think most of the insurance solutions are available. And this kind of very capital efficient, in my opinion, where I have to get insurance to my exposure to every protocol. And the risk I'm trying to get protected from is what the protocol is exposed to, not necessarily what I've done, matter. And so what we're trying to do is create an insurance solution for these protocols that get to start protecting their communities. Now, the model we're looking to build is we understand that business insurance or any kind of form of business insurance has, you need to have pretty high payouts to create coverage. And any protocol promising to pay out a business right now, unless they have a $2, $3 billion pool lying around, they can't even begin to start insuring protocols. And so our approach is very different, where we actually combine a lot of finance concepts to build an insurance pool long term. And what we do is protocols say they want $30 million of coverage for their exposure liquidity pool. They can post it, and rather than a business himself just insuring and promising to pay out, even though they have the money, which we won't, no insurer would in the industry right now. People can stake capital and receive a high rate of return for covering the downside risk. Take Aave. If Aave wanted $30 million of coverage and they're willing to pay, say, a 20% rate of return in Aave tokens, if I stake 100 USDC, I can receive a 20% rate of return in Aave tokens. And now the problem here with steady state, and what we're trying to solve, is like, if we're trying to incentivize people to stake capital into our model or our system, and just like if you put money into a pool and it gets hacked and stolen, well, if a hack does happen, you're protecting your pool, you're going to lose like money. And again, by protecting the hack. And so the problem we have here now is a new kind of problem where like your upside is 20%, your downside is 100%. Why is that a good bet? And, and I think when we think about models, you're always making bets like that, but this is much more apparent. And I think a more proper strategy on conventional state capital, rather than is to allow them to control their downside risk. And that's where we build these things called index pools. Index pools mirror structured products, studio credit default swap models, and typical traditional finance, where basically it's a pool with percent exposure to all these different kinds of insurance pools or these protocols. So if an event happens, rather than your downside being 100% and the payoff from staking your capital, it's 2, 3, 5%. But your upside, let's say, is a 20, 25% return and a punch of tokens all across the DeFi ecosystem. You're naturally accumulating a bunch of tokens naturally. Blue chip DeFi is the highest rate of return possible, say, in the industry, while actually getting controlled downside risk. Meaning that in the industry, we're trying to build these pools where your end term return will be net positive. It's almost likened to like the first bond in DeFi, but like rather than like you buy a bond, like an Apple bond, you receive $1. You're basically buying the risk of Apple and getting paid in Apple stock. And that's a really interesting concept.
It is extremely interesting. And that's why I wanted to bring you on, because when I first heard it, I was like, man, this is revolutionary. So for everyone listening, I'm sure there's a lot to unpack. I'm going to try to make sure we unpack this for you, because what Jonathan is trying to make here is extremely impressive. Especially once executed, like it could really help change the game. So in traditional finance world, you have index funds. Index funds, if you listen to a lot of different financial books, everything else are typically your safest types of long-term investments because they diversify and they typically, in the long term, outdo a lot of other types of funds that you could get into. So essentially trying to create an index fund in the crypto DeFi world. Now, typically when you would put in money into like an index fund, let's say I put in $1,000 and I can hopefully expect somewhere between 5 to 8% year over year. But when I'm ready to cash out, even though I'm getting into a lot of different stocks like an Apple and Amazon, whatever else, I'm getting paid out in US dollars. But instead for this DeFi fund, the way that Jonathan's explaining it is that you would actually get paid. So let's say in this hypothetical world, I'm doing an index fund that has Bitcoin, Ethereum, and Chainlink and DOT. So essentially I put in the money for this, and instead of getting paid back, let's say I put in $100 worth of USDC, it gives me 20% of each of those. Instead of just getting $20 back, now I'm getting $20 worth of all of those different assets that were in each of those. Does that about sum it up?
Yeah, that's a good explanation. Where exactly how ETFs work is you have one token with your exposure to say like one stock with your exposure to 100 stocks, and it's the return 5-8% is weighted. Versus us is like we're just going to pay you. You're accumulating tokens, and your exposure. You're not just exposed to the growth of all of them. You're actually accumulating. So it's like you're buying an ETF, but you're getting paid like a dividend in all the stocks, and that's what makes the model really interesting.
Absolutely, man. So one, that sounds very appetizing. What are the ways that, as you model this out, is it that anyone can get into it? Is it that there's going to be certain thresholds? Like when I put in my money, am I now locked up for a month, a year, 2 years? Like, how's that model going to work?
So when it comes to like total value available to buy, it'll be comparative to the total available in that index pool. So if the threshold value is $150 million and like it's staked up to $150 million to cover, say, 5 protocols on a mixture of like, 30 million exposure each to, coverage, then there's only 150 million available. And so like, it's all about the structured product build and how you make it available. So the problem I see in a lot of crypto, answering your question about like the lockup period, the problem I see a lot in a lot of these kind of crypto insurance funds, whether it's retail or people trying to take the same approach to protocol insurance, is they want to make sure that you can stake your capital and be able to unstake your capital when you want. I love Nexus Mutual. I use Nexus Mutual. I think it's a good system. Has its ups and downs, but it's a good start for where we're trying to go in the industry, I think. And with Nexus, if I stake my Ethereum and I want my Ethereum back to unstake, it takes 90 days for me to unstake my capital, which is a really capital efficient model. And so I started thinking about what model is available where these guys are staking money on risk and all these Nexus Mutual type models. And they, rather than that, it's like, how do you make that liquid where if you unstake, you're sacrificing your underlying collateral to the protocol? Well, I was starting to think, what are models that, you can stake like people hand money over, hold some kind of a object that, receives returns, and then you can trade that object around. And that was a bond market. So what we're looking to do is basically when a business produces $100 million of bonds, let's say, and someone buys $100 of those bonds, then basically when I hold that bond, I rather than give it back to the business, I trade around in a secondary market. And so when you take 100 USDC in these index pools, you'll see like a Uniswap, a synthetic tool. We plan to actually create a new use case for Uniswap and Sushi and other dexes where you can now trade the staked index pool capital, where say steady state DAO will buy a portion of them, probably liquidity in the models and have some kind of great values, and you can trade those around secondary markets. And that's how you're going to make it liquid. Is rather than staking and unstaking for 90-day periods, you're going to just trade the underlying collateral around just like you would normal other kinds of risk debt objects. And that's what we're trying to do, where it's going to be liquid. And Uniswap V3 is a perfect use case that builds something like this out.
Yeah, man, that is really cool. I think that's going to make a lot of people attracted to this opportunity. Something I want to go backtrack to for a second is I really want to unpack the idea of, for some of the liquidity pools that are out there, you can get a 20% APY, but you have 100% risk, right? If there's a hack or whatever, you lose everything. How is it that Steady State is able to help kind of bridge some of that and deflect some of that risk? So my understanding is, like, for example, let's say that in a pool of 20 tokens, that means that you roughly have exposure, a 5% exposure to each of those tokens. So if one of them gets hacked, that means that, you're you're still safe for about 95% of your upside. Is that kind of how that's broken down?
Yeah, exactly. And you're still receiving the tokens, let's say. It's the protocol, it's the underlying value. If I stake $100 USDC, I'm going to lose $5 of USDC in the underlying capital. Is it to pay out the protocol from what I staked? But I'm still receiving the tokens, and so if you're long on a protocol, this is almost a great model where if it gets hacked like crap, but the token value decreases. So if you just keep the capital staked in that model, maybe building that $5, is you're going to accumulate a lot more tokens at a lower US dollar value, which means you're going to get a lot more naturally, which makes it a more interesting model there. But exactly what you're saying is exactly how it works.
Yeah, no, that's awesome, man. And it just seems like there's a lot of layers to this and a lot of ways that people can find an opportunity to be able to create some of this passive income that we were talking about earlier, right? So you're securely putting your money into a place that you can feel safe about getting a high APY, but then also de-risking your downside as well. So like from a roadmap standpoint, where are you presently at and like where are things kind of headed as steady state continues to be built out?
So we're currently built out. We're about 30% built out. Our product team has been working. We're now centralizing for a period of time to build the product more quickly. We're hoping to have a test net out between November, December. We're going through audits and hopefully have a full product with token launched, a utility token launched with product in March or February, sometime or January, sometime Q1 2022 is our plan to launch. We don't want to just launch a token. We want to launch a token with product and with utility value to make sure, we're meeting a lot of different security requirements.
Definitely. And I believe you actually had some pretty good news come out about something that you're doing with Chainlink. You want to talk about that?
Yeah. So one thing that makes our insurance model relatively attractive is we're automating a lot of the insurance claims for the protocols. So the problem with a lot of different insurance claims processes in DeFi and crypto right now is if the claims payout for retailers on Nexus is about 18%, I think. Our team just did research on it a couple weeks ago and just handed me docs. I'm like, wow, it's really that low. But basically, if I file a claim on Nexus, and the chance of a payout is 18%. Now, not saying any. Now, based on our market research we did in February and March, is we found that no protocol was going to trust pay high premiums to a business model. It's going to pay them, has an 18% chance to pay them out if an event happens. So it's 82% chance of loss. So it's like, okay, I'm not going to bet on that. I'm going to keep my own treasury. So what we're doing is we're trying to automate the events in crypto and DeFi, like the known events in DeFi that we categorize, whether it's Oracle manipulation, flash loan attack, black bug, black hat exploit. We're categorizing these events and putting criteria on them. If this, then hit payout. And we're using the Keepers network with Chainlink, which is just recently released. What the Keepers network basically is so smart contracts are great, but they're also pretty dumb in the sense where, there is an agreement, but you have to input data to receive an output. And someone has to walk in and input the data. What we're using the Keepers network, what it's supposed to do is it tracks a bunch of on-chain data where you're trying to get the search for. When it finds the data you're trying to search for, it'll input it naturally into a smart contract without people ever having to be involved. And so we're one of the first integrations and key use cases for the Chainlink Keepers network, where it's going to be tracking data all across like different kinds of protocols and different kind of variables and metrics you're looking for, whether it's mempool transactions or gas prices or key code change manipulations, and it'll basically take all those different data. And when it sees an event that's like and that triggers a payout, it'll just naturally flood it into the smart contract. And protocols find this to be a system they can trust a lot more, because it's automated rather than a mutual vote. And because of that, they actually know that like if the event happens, if it meets the category of this event, then I'm going to get a payout. And that creates, our goal is to get a 95% success rating on the payout, which will be substantially better than 18%.
Which is awesome that you're able to build that out. So just so I can kind of layer that back just a moment, just so I can unpack that for a second. You're essentially able to create a protocol that for people who participate through steady state or what have you, by validating these different smart tracks that are going on, there will be a reward for those validations. And so by having like a 95% quality rate, that's a whole nother kind of work stream of revenue that would be able to come into the company. Does that sound about right?
Yeah, that sounds right.
Gotcha. Oh, well, that's cool, man. I mean, it just sounds like y'all are trying to find as many creative ways to be able to bring revenue opportunities to people who participate in steady state. And I just know through offline conversations, it sounds like there's even more things that are kind of on the horizon in the future, which we will save to unpack at a later date as those developments continue to happen. But it sounds like this is an exciting time for a lot of what y'all are building right now.
Hey, we're really excited. There's really two models. We got to ensure the protocols. We got to get rid of people stake capital. And long term, we're going to take the fees we receive and build our own insurance fund. It's going to float on top of the whole model, and we're keep the APYs high for the stakers while reducing it for the protocols. And I think our approach will be very, very successful in the long term.
No doubt. Well, steady state's definitely one I'm going to be looking out for, and I think everyone listening, you should be looking out for too. Just as an aside question, as you look into the greater crypto realm, right? We're heading into this next decade of crypto and blockchain technology. We've seen this explosion in DeFi. We've also seen NFTs beginning to take off. We see different, Web3s continue to develop as well. What do you think the short-term futures where a lot of people should be paying attention and seeing a lot of things start to develop? But you think it's in the insurance space, or what do you think people should be looking out for?
If you're thinking about like different opportunities, like front run opportunities in the space, I would say gaming is still a very incredibly undervalued industry, crypto gaming. I'd be definitely putting a lot of eyes there. I think the market cap is significantly lower compared to the total potential value. I think, I'm not sure if we're in a euphoria stage of NFTs. There's still a long-term window there. I think DAOs may be the next big, NFT summer. DeFi summer could be DAO summer. I think next year I'm hearing a lot of people building really interesting models in actual companies, corporate, public companies. But I think the next big play, if I was going to do research, would be gaming. I think gaming is a weird marriage in the space between crypto, blockchain, NFTs, and DeFi. And I think it'll be really fun for people to start exploring that and also see, if I was encouraging anyone to look at like short term or the next 2 to 3 months to be gaming. After that, I'd say DAOs and, always keep a long view on DeFi and NFTs no matter what, because that stuff is going to transform a lot.
No doubt. And just to echo the gaming, more and more people I've been speaking to have been telling me that as well. And I say it on the show a couple of times. When you hear something, 2 or 3 times in a short amount of time, pay attention. Even as I look at some of the newest ICOs opportunities that have been in gaming lately, they've been doing pretty well compared to the rest of the market. So I'm definitely going to be spending more time and attention on that. So thank you for putting that on everybody's horizon. But, as we kind of wrap up here, man, I always like to ask these final 2 fun questions. One of them being, with all the knowledge you have right now, and if you could go impart 2 to 3 pieces of wisdom when you first got started in the crypto space, what would you tell yourself?
There's a lot of noise. I would tell myself, trust your gut and bet on yourself. Would be the first thing I would tell myself. I have a lot of people, advisors, and people offering strategy, and all these other things trying to give me advice. And you have to just learn to pick what you can and ignore the rest. And that's like a really key thing. A lot of people don't do well. I think another one is like aim to be better every day. And aim to be better every day. Treat yourself like the standard for yourself, and just for yourself. And when you're leading groups of people, make sure you're the standard, and everyone else has to strive to meet. So it's better to ignore the noise, be the standard. And I think the third best advice I can give is keep your peace. I imagine you have a lot of people in crypto, entrepreneurs, and listening to this call. You guys go through a lot of stuff on a daily, weekly basis. I have to be very careful not to lose my mind. I think people have commented that I sound a lot more stern when I talk, but also that I sound way calmer than I did 2 months ago at the same time, where I'm just like, right. You don't seem fazed by much, but also you seem very fazed. I'm like, yeah, I'm just learning to deal with it. But it's like, just find your peace. For me, I go play sports. I was playing volleyball yesterday, and then ultimate frisbee. And then, I just want to be active when I can, whether it's the gym or anything. And so I think it's a big thing is, ignore the noise, trust your gut, bet on yourself, be the standard. And third is find your peace. And I think those are like kind of the 3 things I lean on more and more every day and try to remind myself every day. Yeah.
No, that is amazing. Great advice. Everyone listening, run that back. Just listen to it about 2 or 3 times. It's important and people lose sight of it. One of them that I want to spend just a second more time on is finding your peace. So there's a moment probably in early summer where like I was just stressed out, just working on a bunch of different things and feeling like I was being pulled in a million directions and just realizing like, no, like I just need to take a moment, take a deep breath, figure out what's important, and then refocus, realign, step away from things just for a second, just to get perspective back and getting that peace back and feeling good about everything. So I think that was a great reminder. So I really do appreciate those 3 pieces. But as we wrap up here, man, what is a final thought that you want to leave with all the listeners here today?
The future of crypto is bright. Don't stop betting on the future. Don't stop betting on the young entrepreneurs. Don't stop betting on what's going on now and what you think is going to happen. Keep your view rather than the next 2 months, 3 months, 5, 10 years. And if you can do that well, then you can get anywhere, I think. And I believe you can be anything you want. And I think with this space itself, if you're trying to be an entrepreneur, if you're trying to innovate, if you're trying to achieve something in your personal goal, that's wealth, some level of freedom, whatever you're looking to do, this is the space to be in. And keep your scope high and always keep on the lookout for the next opportunity. And rather than be skeptical, try to be creative, ask constructive questions, and just for the goal of learning rather than critiquing. And I think people who do that are going to really going to be the leaders in the space.
No doubt. Amazing final thought. Jonathan, really appreciate that sentiment and everything that you shared with us today. What are ways that people can connect with you and learn more about everything going on at Steady State?
Yeah, Steady State DeFi is our Telegram. Steady State DeFi is also our Twitter. Feel free to, John SST is my Telegram if you ever want to reach out personally. Would love to connect with a lot of people over to the Telegram. And then if you want to talk to me personally, I'm always available. Try to be available as much as I can. 13 hours a day at least. I'm trying to. But it's, I'm always down to grow our community. I'm always down to teach people more. And our website is steadystate.finance. So a lot of different links you probably can share below, and we can really get people interested in what we're doing.
No doubt. Well, we're going to share all of those links in the show notes. Again, we really appreciate all your time today. And for everyone listening, stay cryptocurrent.